Despite Alibaba being up by over 44% year to date, the stock has basically traded sideways around that $120 mark since February of 2025. And while this is a big improvement based on the prices that we've seen over the last couple of years, in my opinion, there is still a large move up in the near future for Alibaba. And the turning point for this stock could very well be their upcoming earnings announcement. Alibaba is set to announce their Q1 2026 earnings on Friday, August 29th, 2025. And here's how estimates are shaping up for this upcoming earnings announcement. Right now, analysts have an average EPS estimate of $2.14. That would be down year over year from $2.29 in 2025 EPS. However, what I want to point out is that analysts have a lot of uncertainty around Alibaba's earnings. And this really tends to always be the case, but it's very clear when you look at their numbers. Because right now, the low EPS estimate is $1.52, while the high EPS estimate is $2.63. That is over a dollar difference in EPS estimates for this current quarter, which speaks to the uncertainty that analysts have around predicting Alibaba's earnings. They do tend to be a little bit more accurate when it comes to top line revenue numbers. The average revenue estimate for this quarter is $35.4 billion. That would be up around 4% year over year from $33.9 billion in Q1 of 2025. Remember that I say Q1 of 2025 because Alibaba has a different fiscal year. This is technically going into their fiscal year 26 for their Q1. That's their earnings that they are about to report. This is a graph of Alibaba's revenue over time. And what's very interesting is how it has leveled off over the last few years. This has a lot to do with the broader economy in China. However, we didn't see a massive dip. At one point, their revenue year over year did go down by 8%. However, it stayed relatively stable around this mark, even seeing some slight increases in their most recent quarters. But despite the company getting back to all-time highs for their top line numbers, we have not seen the same trend for their bottom line EPS numbers. Right now, their trailing 12-month EPS is sitting at $7.38. That is still down quite substantially from where it was back in 2019 of $9.37. A lot of this has to do with additional competition throughout China, as well as weakness in the broader Chinese economy. What this has done for Alibaba is force them to drive down some of their prices to continue bringing in these higher revenue numbers, and that ultimately affects their bottom line. The problem that China is running into right now is that they spent years cracking down on monopolies, finding businesses like Alibaba and trying to increase competition throughout the country. What this ultimately has done, especially with a lot of other economic factors with the pandemic and other things going on throughout the country, it has actually created so much competition that they are experiencing deflation. And basically what this means is that there is a clear imbalance in supply and demand. What the country is focused on with cracking down on these monopolies is they have actually created an overcapacity in manufacturing, and they have not focused on actually increasing demand. We have seen the supply increase throughout the country, and this is one of the things that China is good at. They are good at exporting goods. However, they have not seen the demand increase throughout China that they need to see to continue growing their economy. So what they are talking about doing now is trying to focus a lot more clearly on boosting consumption throughout the country. And if the Chinese government is effective at doing this, what should ultimately happen is it should decrease competition amongst these companies, ultimately leading to an increase in profitability. But at the end of the day, what really matters is how they actually execute on this strategy. So far, they have taken a very slow approach to lowering interest rates. In my opinion, if they want to continue growing their economy at a quick pace, which their target right now for GDP growth in 2025 is 5%. I think honestly, for them to hit that, right now they're actually on track to hit that. However, in the next couple of quarters, they need to be more aggressive on lowering their interest rates. Even if this comes with a little bit of inflation, I think overall the Chinese economy will benefit immensely from this potential lowering of interest rates as well as kind of loosening of monetary policy. And obviously, ultimately, if we see this loosening of monetary policy and consumer confidence throughout the country start to increase, that will have a huge benefit on Alibaba. And that should ultimately impact their bottom line, probably more than their top line numbers, which I think should result in a larger move up in the stock price. Right now, we can see over the last couple of quarters that a lot of analysts have not been super accurate at predicting Alibaba's EPS numbers. And that could easily continue into the future if we get some changes in monetary policy from the Chinese government. However, until we actually see that large turning point in monetary policy from the Chinese government, I think the main thing that Alibaba needs to continue showing growth in is their cloud business. Cloud growth in their most recent quarter accelerated to 18% year over year, and their AI related product revenue growth actually maintained triple digit growth for the seventh consecutive quarter. The reason cloud growth is so important for Alibaba, especially in this quarter, is because the numbers we have seen from all the other top players in the cloud market have been very impressive. We have seen 30% growth for basically Amazon, Microsoft, and Google. Alibaba, if they can come in and put up 25, maybe even low 20s% growth, I think that is still a good move in the right direction for the company, especially with what we have seen with a lot of US companies actually utilizing or paying into Alibaba Cloud. If you think about a lot of companies and where they actually outsource some of their menial tasks, it is to India, it's to China, and it's to other Southeast Asian countries. What are those countries using for their cloud space? It is Alibaba most of the time. So ultimately, a lot of these larger US companies are indirectly paying into Alibaba Cloud. And also keep in mind that Chinese companies tend to adopt technology at a slower rate than US based companies. What that could ultimately lead to is a larger expansion from Alibaba Cloud over the next few years, as a lot of these Chinese companies that haven't gotten into the cloud market yet starting to adopt this new technology. Here's the thing with Alibaba. Right now, analysts are expecting the company to only put up $8.72 of EPS in 2026. I personally think that that is a little bit on the lower end. I think that over the course of this year, if we see the Chinese government take the right approach to their overall economy, we should see Alibaba produce better results than 872. What they do expect is that in 2027, we will see a turnaround in Alibaba's business that will result in EPS numbers closer to $10.50. I honestly think that that could actually happen in 2026 if, again, we see this turnaround in how the Chinese government actually approaches their economy. But if we do see them put up $10.50 of EPS, right now they're trading around a 14 forward PE ratio. I personally believe that Alibaba should easily trade at least a 20 PE ratio, but they could trade anywhere between a 15 and a 25 forward PE ratio. If they were to trade at a 20 forward PE, that would result in a stock price of around $210 per share. That is very much above the current price level of $123 per share. But if we see a larger increase in growth and this actually expands their valuation multiple, we could see them trading at a 25, maybe even a 30 forward PE ratio. At a 25 forward PE, that would result in a stock price of $262 per share, basically over a double up from the current stock price. So for me right now, I see Alibaba over the next 2 to 3 years as at least a double up, if not even greater, if we see more growth from the Chinese economy than what analysts are currently expecting. And ultimately, that is why I hold Alibaba in the portfolio, because there is a significant upside, in my opinion, with very limited downside to this company. Right now, this is the YouTube portfolio, and it's currently up to $74,444.64. Overall, Alibaba is a smaller position in this portfolio. I only hold 15 shares for a market value of $1,800. However, I have a significantly larger position in my main portfolio of Alibaba. Again, just because I have a lot of belief in this company over the next few years to produce some very good returns. In this portfolio, we are up almost 60%. However, in my other portfolio, I've been building out the position a little bit longer, and my gains are closer to around 20 to 30% in that portfolio. Honestly, in my opinion right now, I don't think Alibaba is a bad buy at all. I think over the next 2 to 3 years, there is easily 50 to 100% upside in the stock. However, for me, I have built out my position to a spot where I am comfortable with its sizing, so I'm not actually actively adding. The positions that I am still building out, though, are mainly in healthcare, United Health, as well as Oscar. I continue to buy into because I see a lot of upside over the next year as that industry starts to turn around. But of course, let me know your thoughts down below. What industries are you keeping an eye on right now? What positions are you building out? And what is your price target for Alibaba over the next couple of years? I'd love to hear all of that down below. While you're down there, drop a like on the video and subscribe for more videos like this one. And if you haven't yet already, go check out my X account and follow me on X. I would greatly appreciate it. Thank you guys so much for watching, and as always, have a wonderful rest of your day.